complacent, suggesting large downside is still
All right,
ahead.
let's listen to
We'll
some,
talk about that, as
meet
well as
Kevin,
how
I
tariffs
guess.
may have just flipped the script on the Federal Reserve in a very
Tesla did
unexpected
very well
way.
today.
Talk about how
Tried to hit 354 twice, or maybe 3 times. It tried the 350, hit the resistance, just banging off of it.
Calls might be in play at open, and boy, oh boy, it has skyrocketed. Now up over 29% at the time of this recording, up over a third since our message. Now, what we've got to remember though, we also got to talk about what Elon Musk just said. And we've got to talk about Klarna, Perplexity, AI, and a whole lot to cover today. Hey everyone, me Kevin here, CEO of a real estate startup, jet pilot, and dad of 7. Let's get into the news today. Quick reminder, if you need life insurance, get it in as little as 5 minutes by going to medkevin.com/life. Super easy to do, and the sooner you sign up for it, the sooner you lock in that premium. Okay, so first, what is going on with Jamie Dimon and what's going on with markets? Because so far, everybody's just buying the dip. Retail bought the most stocks ever at the stock market open yesterday, and for the first 3.5 hours, or you can say 4 hours, or 12:30, we saw the largest buying by retail shareholders that we have ever seen in the history of tracking retail buys between market open and 12:30 Eastern time, that 4-hour window. The largest by a massive magnitude. It seems like people basically researched the whole Moody's drama and we're like, all right, every time we have one of these credit downgrades, they end up being a buy the dip. So, well, let's buy the dip. That's exactly what happened yesterday with the S&P 500 and the Qs going from negative 1% each to positive. Retail really just does not give a flying F about selling right now, and the idea is buy, which in fairness has been working really, really well. There has been no broad concern, and we've even here on the channel been talking about using trailing stops as a tool for maximizing the gain and minimizing potential downside, and so far it's just been straight up since we've been talking about those in mid-April. Small caps, in fairness, are seeing the largest outflows out of all of the various different funds that we could look at, whether we're talking large caps, medium caps, small caps absolutely getting hosed with a cumulative negative $68 billion, the largest outflow ever in a year to date, and then again for small caps. But if everybody is so bullish, then what does Jamie Dimon see that's bearish? Well, first, he says credit risks today are really bad. And not only are credit risks bad, but asset valuations in America are very expensive. And he says that the people who are buying right now are people who haven't been through a real downturn. I think he's basically trying to cast aside COVID and the tariff dip as not real downturns. And I think he's thinking back to like a dot-com bubble or even a Great Recession, where you had massive unemployment combined with a serious downturn. Very similar reaction to the monetary system.
That's not necessarily true. See, I'm 35, but I was investing in stocks since I was elementary school age, and I've learned about don't put your everything in one basket, because when I was a kid, my uncles would give me money for my birthday and be like, this was during the dot-com boom, is you have to buy AOL, you gotta buy Global Star. Guess what? They're all freaking bankrupt. But that put a little thing in the back of my head. And then, little idiot me, I actually buy Netflix when I was a teenager because I liked the service. My parents then sold it and they said, who the hell wants this crap? Guess what? I would have been a millionaire. Well, not a millionaire. I only had like 30 shares, but like, parents, I want you to buy me this because I like it. Oh, anyway, it kind of dipped and they sold it. Like, DVD streaming service? What is this? This will never catch on. Wiped out Blockbuster. But yes, we have been around. We've been through the 2008 crisis. I graduated into the 2008 crisis, basically. So that's when I graduated from high school. Then we went to college. The company I was working for, interning for, back in 2008, 2009, they closed their U.S. office. We all got laid off. Hutchison, or in their cellular software department, or video streaming, if you will, Videator. That was cool. But anyway, we learned, in a sense. Not learned, but we've experienced pain in the markets. And people of my age now, if you're a young professional or whatever you are, or you've got some money and you can have some fun with it. We don't have many kids. Not many of us are married with kids or whatever. We're sitting on piles of cash, and don't have much to really risk. I mean, if it all goes to zero tomorrow, I'm still alive. So why the hell not? But we're YOLOing it on things like Tesla. I like the product. I like the car. I mean, look at how this is running through the freeway right now. This is freaking fantastic. So I'm not stupid. I got my money tied up in Tesla and Palantir. As they say, Tesla.
Congress and Fed were kind of slow to react, unlike what we've seen over the past crises, especially COVID. So Jamie Dimon says that trade and this sort of tariff war that we're going through is creating a lot of risks that we just haven't seen yet. And those risks may take time to come. He says there's an extraordinary amount of complacency and that we are on the fringes of extremes, considering that even at the lower levels that we have now for tariffs, we're still at extreme levels we haven't seen in decades. In fact, a blanket 10% on all countries hasn't been seen since 1971. And if you combine all of the tariffs that we now have on global trading partners, we have the highest tariffs since the Great Depression. So Jamie Dimon sees stocks selling off by at least 10%, but he's not so worried about that 10% because we just had that in April and got through it. Big deal, right? But he actually thinks that the resulting credit crunch could hurt Americans even more. So what I wanted to do is sort of compare this to what's going on over at SocGen. And SocGen gives us a little bit of an idea of, okay, how are these tariffs, like when are we actually going to see tariff impacts? But then T.S. Lombard says something crazy that just flips the tariff script, and I want to show you that right after I just take a quick look at this. Dang, look at that. Since the open, it's you know, a little volatile there at the open, but it's basically been straight up on D-Wave. We'll talk about them soon.
All right, we're just going to follow the map because we're supposed to take the 520 bridges on the left. But you know what? This is going to be kind of a cool experiment because it wants us to take this exit. Now, it hasn't taken a phantom exit to save time or not in an error in quite some time. So why is the algorithm taking us off the freeway and I guess back on the freeway? What the hell are we doing? Why are we getting off the freeway? I'm just going to let it play out in the name of science because there's really no reason to do this. Okay, so effectively you screwed me. Okay, I should have intervened. I thought this was just, I'm just playing this out for the mirror of science, I think, at this point. No, it's got a plan. Interesting. Okay. So I'm seeing down below, what is her plan? Got us off the freeway, and I kind of see it because the speed of the freeway isn't very fast. Oh my god, this might actually be... Huh. Okay. Huh. You aggressive driving little... Genius. And it didn't use carpool lane. Okay. It had a plan. It figured doing this was faster than sitting on the freeway. And we can look from the footage. Maybe I'll roll it back, but I think we are going to gain. I mean, I don't know how much this gained, maybe a minute, but you know what? We'll take it. So it must have input. I mean, this is what's really going on in the 13.2.9, where it's starting to correlate on the back end data from the fleet. Okay, we have stopped for the homeless person, which is fine, but okay, what are we doing here? Been doing really good up until this point. All right. So I did tap the gas. It's got a little hung up, but yes, this may be an issue for, okay. Bug report. So the car stopped for a panhandler that I think the car was really thinking was a pedestrian wanting to cross the road, which was not the case. This is a panhandler holding a sign, please give me money. So the car needs to differentiate between panhandling and pedestrian crossing the road. Thank you. Error occurred. Maybe my bug report was a little too long.
It's about ETS, but okay, we won't go that direction. But it's all in one app. Especially since now they also have their high yield cash accounts or access to different funds that give you high yields as well, which, you know me, I'm personally of the mindset that, it could be a good idea to have a little bit of a rainy day fund sitting on the sidelines earning some cash before JPOW takes those good yields away. So Public.com makes this easy. On top of that, they're integrating AI tools and fundamental data and analytic tools right into the app. They call it alpha, which is awesome. I like that phrase a lot too. In fact, everyone's looking for some more alpha after all. Now, what's neat about Public is you can fund an account in less than 5 minutes, maybe even less. And if you transfer your old portfolio over to Public, you can earn up to $10,000 as a bonus. Now, that's the kind of free money that I love, especially if I'm getting more bang for my buck. So if you're at a different brokerage and you're looking for
that was kind of discourteous.
In my opinion,
gotta wait for the white car FSD.
A try. You can download the app. You can use my link in the description down below and check them out. Public.com. Use my link in the description. Maybe. So take a look at this one. The positive. Okay, so they're talking about charts for inflation, and they're also referring to an article from the Federal Reserve, and they say the Fed says that the impact of tariffs has been obscured by other price movements which have declined to offset tariffs. Put another way, U.S. inflation would have been even lower without tariffs. Central banks just love a counterfactual, don't they? Okay, let me translate this. If it weren't for tariffs, we might have been in deflation, and the Fed could have cut. So in other words, tariffs basically made it so that the Fed didn't have to cut to stimulate us because we were in deflation. Instead, tariffs just brought price levels up back to sort of an acceptable wait and see level. And so tariffs are basically duly responsible for keeping rates higher for longer. Which makes sense if we assume that tariff pricing has already hit, which T.S. Lombard says to some extent we've already seen tariff pricing start coming through. SocGen says, nah, not so fast. Wait until August, because that's when the poop really hits the fan. Who knows? But it's kind of interesting because, as usual, it means bonds got the short end of that stick. Whoopsies! In the meantime, though, Home Depot and Walmart both reaffirming their fiscal guidance for the year. Home Depot sees growth of 2.8%. They see the economy getting through the sort of Q2 bump. And even though Walmart didn't provide Q2 guidance, Home Depot is. And their stock's up today. Markets are kind of happy with the earnings. Operating margin guide came in a smidge lower, but Q1 sales came in a smidge better than expected on a dollar volume basis. The comp sales missed a tiny little bit. Remember, the difference between that could be the opening or closing of locations. Anyway, gross profit at Home Depot 33.6%, net profit of 8.6%. So that actually brings some decent money down to the bottom line. That said, a lot of people are wondering, is the economy just being propped up by BNPL services? So Klarna is a service provider for both Walmart and Home Depot. And the Financial Times just reported that Klarna's net loss doubled to $99 million for the 3 months ending in March, which is nearly $400 million annualized and more than double the losses that they had last year. Customers failing to pay has risen by 17%. However, if you look at this sort of on like a total losses in terms of dollar volumes, they're only at total losses of about 0.54% versus 0.51% last year. So the dollar volume level isn't up that high. It just seems like more people might be
I'll make a comment about the buy now, pay later places. They are on everything. Now, I get it. You buy like a treadmill or something. It's like, like a couple of $1,000, and you take advantage of like a low interest, or when they put 0% interest, and yeah, why not? You do your buy now, pay later, or pay in installments of a large purchase. It just kind of makes sense. But if you're buy now, pay later, your grocery bill or something like that, well, you're asking for trouble because you're in a different socioeconomic area. You've moved from financing a discretionary purchase to financing a necessity or something with a high default risk. And I've used I think it was Clarence, one of those before, because it was 0% and there was no penalty and there was no real advantage to using a credit card versus the buy now, pay later, because it gave me a 5-year note. Credit card might have given me a 1% cash back, but I pay it off at the end of the month anyway. So I use the thing. That's where it kind of comes in handy. Anyway, there's going to be a lot of defaults, especially since they're doing it on these micro purchases, basically, where you can finance your Uber Eats.
But dollar volume-wise, the defaults aren't actually that substantial. I personally think the losses are why Klarna wanted to IPO quickly, to get access to equity markets and kind of help fund those losses. But I do think it's also possible that, Klarna just wants to kind of IPO at a peak, and Walmart and Home Depot might be able to get through the 2025 drama in part because of Klarna. So you're kind of changing market dynamics in a very interesting way, where maybe you can sort of like basically borrow your way through a recession, and then you don't actually get a recession. The question though then becomes, okay, when does the bill finally get paid? My guess is probably never, or the stock market will just absorb those losses. You're sort of like socializing BNPL debt. Very interesting. Then when it comes to Perplexity, oh boy, this one is perplexing. We'll talk about it, but quick reminder, thank you to those of you, especially those of you who are international, who are investing in HouseHack. Really appreciate the confidence and your ability to diversify to U.S. real estate. Remember, if you're a non-accredited
bug report, the speed limit indication on our navigation screen did not change when the car passed over a sign or passed under a sign that said 60 miles an hour, failed to read speed limit.
Consider going to househack.com and investing in our 5% convertible round. You get paid 5% per year. We pay it out on a monthly basis. You get that direct deposit on a monthly basis. So it's sort of like passive income. And you get that through conversion of the stock, which only happens if our stock value goes up. And we are a pre-IPO company, so read more about the company at househack.com. You can see some of the projects that we've got going on. And we look forward to working for you. Anyway, go check it out at househack.com. Remember to read the disclosures. There is risk with every investment. Now we got to talk Perplexity. Perplexity had $34 million of revenue last year, but the costs for OpenAI and Anthropic plus AWS services that aided the company were $57 million. So in other words, the company is losing money. In fact, if you kind of look at their profit pipeline, if you will, we'll go ahead and pull that up on screen here, you'll see that the company also is kind of clever in how they rearrange things. See, this is kind of brilliant. Perplexity says that people who are on a trial subscription or on some kind of other discounted subscription are actually just paying a subscription, and then that is just discounted down over here. Now, the reason companies like to do this is because often they get valued on what's called annual recurring revenue, ARR. So the bigger you can make this number look, the more money you can raise. But it's kind of a lie, because if you really took the trial people or the free plans out, your subscription revenue would only be about half as big as it is now. So it's a little misleading. They also suggest that they're gross profitable to the tune of about $34 million. But they're literally putting parts of their costs of goods sold, like OpenAI and Anthropic models like Claude, and costs related to those of $8 million. They're putting that down here in the operating expense section. And they're also throwing all of their payroll into R&D, it looks like. Plus, they're throwing all of their web services for AWS expenses into research and development as well. So in other words, they're trying to make it look like the core of the business is losing money because they're growing the business, which is not abnormal. Like, you want to see a startup have a positive gross profit level and then reasonable OPEX. And yes, the OPEX can create a loss. It's very normal for a startup, but you want the top line to be very profitable. You work on improving margins, and as the company scales, it tends to offset any kind of net income and you actually get to a growth phase. This is very normal. This is like Startup 101. The problem here is they're kind of providing, in my opinion, a distorted picture by putting their AWS and OpenAI and Anthropic fees down here when they should really be up here. And the information argues that as well, because it's convenient to say you're gross profitable, but you're actually probably losing money. So that's that's Perplexity for you. They're also, by the way, in talks to raise $500 million at a $14 billion valuation. This will be its fourth funding in just over a year, and ended last year with $850 million in the bank. So they've got lots of money to burn. I mean, if they had $850 million in the bank and in 2024 they lost $68 million, technically they've got like 10 years of money to burn here. So they've been able to raise a lot of money through this sort of artificial intelligence momentum. But what is also interesting is another company called Builder AI, which partnered in Microsoft in May of 2023, as well as the Qatar Investment Authority, to, quote, empower businesses to develop applications and become digitally native without the need for technical expertise, is going bankrupt. So that means they literally lit $450 million on fire, and that company's going bankrupt. So, there is the potential for just malinvestment in artificial intelligence. We're starting to see some of that. Now, another thing that we also talked about in the Alpha Report and the course live this morning is CoreWeave. We talk about how CoreWeave's momentum continues to power on, as it had since NVIDIA's been bailing them out under $40 a share. I personally mentioned this morning that I don't think a lot of investors in CoreWeave who sort of came in late on this momentum realized that NVIDIA was bailing them out when they were trading for under $40. And it really wasn't until people saw that NVIDIA disclosed an ownership stake of about 7% in CoreWeave that CoreWeave really skyrocketed. I think people saw it as sort of like a cheaper way to get exposure to NVIDIA. And in the short term, I think the financials are fine. They've got some more debt to raise to make sure they're stable. But in the longer term, one of the big problems that you face with CoreWeave is they're probably going to end up being an AI bag holder as those assets start depreciating substantially more rapidly than we're actually being told. I actually think their $14 billion balance sheet is probably already overstated. But as long as companies like NVIDIA keep partnering with CoreWeave and keep the ball rolling, you don't need an AI reckoning for a lot longer. So that's why I recommend it's, to me, we've been talking about buying call options on it for the last couple weeks and bullishness coming off of the $35 trade. But I was also asked, like, Gavin, should we short CoreWeave? I go, look, the problem with shorting CoreWeave is you're betting when it's going to fall. I don't know what the answer is as to when it's going to fall. I think that in the longer term, it's probably not a company I want to own and have my eyes blind to. It's potentially a trade in the short term. Anyway, that's one to pay attention to. So that gives us a little bit of a breakdown of what's going on with some of the AI plays. But I think it's also worth touching on what's going on with D-Wave. So D-Wave is a really interesting one. Okay, D-Wave gets about 85% of their revenue from one customer. Now, I think this is actually not great. It's been great for the company because they've really been able to explode their revenues. But when you have 85% of your business coming from one customer, mostly research customers, the broad-based business application for D-Wave, I don't think is very valuable. Now, in fairness, I did say this morning in the Alpha Report, I said, hey, calls on D-Wave. This thing's probably going to keep momentum rocketing, and it did. You know, it's up a third from when we mentioned it. So how do I reconcile that? How do we reconcile that in the short term we could be bullish, but longer term we're not? Well, first of all, D-Wave's momentum's been kicking butt since November. This stock is like 15x. So you can't fight this momentum. The momentum is so crystal clear, and you don't want to stand in the way of momentum because you're going to end up getting hosed. The problem with the company is people look at it as a quantum compute investment because it's literally called D-Wave Quantum Inc. And they talk about quantum compute as a service, so QCAAS, which, you know, everybody relates that to SaaS businesses, software as service, and the money that's made over there, and people get really excited about it. The problem is quantum computing technology that D-Wave uses is an annealed process of quantum computing. It's actually not true gate-style quantum computing, which would be your most advanced, like we could break cryptography quantum computing, or the quantum computing that like Google is doing in their research labs, or Microsoft is doing, where they're like so excited they're able to get their technology to operate for a fraction of a nanosecond. That's sort of like full-fledged quantum computing. D-Wave is more like, hey, we have one way to solve really specific research applications, and we're really good at doing this one niche thing. So it's not general purpose quantum compute, and as long as you know that, then I think it's more fair to look at Quanta or a company like D-Wave. Now their revenue exploded to $15 million from $2.4 million in 2024, which actually gave them a nice gross profit. But again,
I just want to enjoy the rest of the ride home. Nice trees. Actuate the windshield wipers.